Do you honestly believe the digital balance on your screen defines your wealth? Or are you just a slave celebrating the size of your chains while real value vanishes from your hands? While the world chases overnight gains and assets that don't exist, a massive supply hole of 820 million ounces has been ripped open in the silver market. This isn't a wild guess. It's the brutal accounting of 5 straight years where global demand has incinerated the available supply. We are looking at a cumulative deficit equivalent to an entire year of global mine production that has simply vanished into the industrial machine. What is your plan for the moment the industry absorbs the very last physical ounce and you realize your paper money can buy what no longer exists? Are you prepared for the day the music stops? 820 million ounces of silver, an entire year's worth of global mine production, has vanished. It's gone. It has been fabricated into products and won't be coming back to the market for years, if ever. This isn't a one-time blip. The year 2025 is on track to be the 5th year in a row of a major supply deficit. Year after year, the math has been simple and brutal. Total demand keeps outstripping total supply. According to Metals Focus and the Silver Institute, the deficit for 2025 alone is projected to be between 95 and 120 million ounces. When you add that to the huge deficits from 2021 through 2024, you get to that enormous cumulative shortfall. So, if there's a crippling shortage, why hasn't the price already shot to the moon? That's the billion-dollar question. The answer lies in a market that's split in two: the real world of physical metal and the fantasy world of paper contracts. For years, the paper market has called the shots on price. But as we'll see, it's the physical market that always gets the final say. The evidence of this deficit isn't some fringe theory. It's written in the supply data. We're looking at the scene of the crime, and now we need to understand how it happened. Stop for a second. If an entire year of production is gone, why isn't the world panicking yet? Is it because the shortage is hidden, or because they don't want you to see the exit door closing? The story of this deficit starts with a fundamental change in silver's job in the world economy. For decades, it was mostly seen as gold's less exciting cousin. But now it's become what some are calling the bottleneck metal of the 21st century. This deficit isn't just about investment. It's driven by a long-term structural demand from the most critical parts of our future economy. First and most important is solar energy. Silver's unmatched electrical conductivity makes it irreplaceable in photovoltaic cells. As countries push for a green energy transition, demand from the solar sector has exploded. While manufacturers are getting better at using less silver per panel, the sheer volume of new solar installations means total silver consumption for this sector remains massive. Every gigawatt of new solar capacity needs tens of thousands of ounces of physical silver. This isn't a temporary trend. It's a permanent structural shift. But that's not all. A second wave of demand is hitting the market from electric vehicles. An EV uses more silver than a traditional car. Some high-end estimates suggest an EV can use between 25 and 50 grams of silver, essential for things like battery management and electrical contacts. With global EV sales climbing, this is another pillar of demand that's locked in for years. And now a third driver is emerging, a wildcard the market has barely started to price in: artificial intelligence. The AI build-out requires a massive expansion of power-hungry data centers. These centers need advanced power components and busbars that rely on silver for its efficiency. Some analysts believe the power and hardware needs for AI could create a demand shock that rivals what we've seen from solar and EVs. For these tech industries, running out of silver isn't an option. Without it, the production lines shut down. Wait. If silver is the indispensable bottleneck for solar energy and AI, why aren't miners digging faster? The answer reveals a structural flaw that most investors are choosing to ignore. Are you watching the metal or just the noise? With demand on a long-term upswing, basic economics says supply should rise to meet it. But the silver market is different. It has a fatal flaw: supply is overwhelmingly inelastic. You can't just flip a switch and mine more silver. Here's why. Roughly 70 to 75% of all silver mined isn't from a primary silver mine. It's a byproduct of mining other metals, like copper, lead, and zinc. This means that for most mines, the decision to produce more isn't based on the price of silver, but on the price of base metals. Even if silver prices are soaring, if copper prices are weak, there's no incentive to expand. Primary silver mines, which are motivated by the silver price, only make up about 28% of the world's output. On top of that, global mine production has been stuck in neutral for years. Projections for 2025 show mine output remaining stubbornly flat at around 813 to 835 million ounces, nowhere near enough to meet total demand. Bringing a new mine online is a huge undertaking, often taking 5 to 10 years and facing massive regulatory hurdles. And what about recycling? While silver recycling is expected to hit a 30-year high, and it does provide some relief, it isn't enough to fill the gap. Much of the silver used in electronics is hard to recover, with an end-of-life recycling rate of only around 50%. It's not gone forever, but it's locked away for a long time. This is the perfect recipe for a physical squeeze, insatiable, tech-driven demand hitting a wall of stagnant supply. Think about the scale of this trap. If the price goes up, the supply stays flat. If the demand goes up, the vault's empty. Do you realize how thin the ice really is for the industrial giants? So we have a documented physical deficit, soaring long-term demand, and a crippled supply chain. Why isn't the price at $100 an ounce, or $200? The answer is the great disconnect, the cover-up that has defined this market for years, the paper market lie. The price you see on your screen every day is not the price of physical silver. It's the price of a paper derivative contract, traded mostly on the COMEX exchange. The volume of this paper trading is immense, dwarfing the amount of actual physical silver available for delivery. This has created what can only be described as a managed illusion. The hand holding it down is the paper market, pushing down with the weight of futures contracts that rarely get settled with physical metal. For years, this has worked. But the pressure from below is getting intense. This isn't just a theory. It's a matter of public record. In 2020, JP Morgan, one of the biggest players in the metals market, admitted to manipulating the markets for years and paid a record-breaking $920 million fine. The illegal tactic was spoofing, where traders placed huge orders they never intended to fill, creating false signals to rig the price. The Department of Justice confirmed this happened on their precious metals desk for at least 8 years. This fine was the smoking gun. It proved the tools to suppress the price exist and have been used at the highest levels. The big question is, if they were caught doing it for 8 years, what makes anyone think the game has truly stopped? Think about this for a second. If JP Morgan already admitted to rigging this market for 8 years and paid a $920 million fine, what makes you think the game has stopped now that the physical vaults are actually empty? Who really controls the price you see? The paper lie can only work as long as there's enough physical metal in the vaults to keep up the appearance of availability. But that illusion is starting to fracture. The tipping point comes when the world's industrial giants, the solar manufacturers, the automakers, the tech companies ask for delivery and the metal simply isn't there. We are getting dangerously close to that moment. The evidence is in the vault reports, but it tells a complicated story. While inventories in Shanghai have plunged to decade lows and London has seen tightness, vaults in New York have recently been overflowing. This doesn't mean there's no shortage. It points to a fractured, disorganized market where the silver isn't where it needs to be. These are the logistical nightmares that precede a crisis. An industrial user can't build a solar panel with a cash settlement. They need the metal. When they can't get it from one exchange, they'll go into the open market and pay whatever it takes. That is the moment the paper price becomes irrelevant. That is when the beach ball, held underwater for so long, finally erupts. We've already seen warning flares like lease rates for physical silver spiking, and the market briefly flipping into backwardation, where buyers pay a premium for metal now instead of later. These aren't signs of a healthy market. They are the tremors before the earthquake. The numbers coming out of the East are no longer just a warning. They are a full-blown alarm. While the West focuses on paper charts, the Shanghai Gold Exchange, SGE, is being bled dry. In the last 24 months, silver inventories in China have plummeted to levels not seen in over a decade. This isn't just about solar panels. This is a strategic hoarding of physical metal by the second largest economy on Earth. When the East decides to drain the West's physical supply, the arbitrage gap creates a vacuum that the COMEX cannot fill. London, the heart of the world's physical silver trade, is facing a similar ghost town scenario. The LBMA vault data shows a consistent trend. Silver is moving into allocated accounts, meaning it is being locked away by private long-term holders and taken off the market. This leaves the float, the silver actually available for trading at dangerously low levels. We are reaching a point where the paper-to-physical Ratio is so distorted that for every 1 ounce of real silver in a vault, there are potentially hundreds of paper claims representing that same ounce. This leads us to the terrifying reality of force majeure. What happens when a major industrial player, a Tesla, a Samsung, or a First Solar demands delivery of 50 million ounces, and the exchange simply says, "We don't have it"? In that moment, the exchange will invoke force majeure, settling the contract in cash at the current suppressed price. But you can't build a microchip with a cash settlement. You need the atoms. The moment a major industry leader realizes they are holding a worthless piece of paper instead of the metal required for their production lines, the panic will move from the trading floors to the real economy. This is the delivery default that ends the paper charade. It is a logistical nightmare that is being built brick by brick, ounce by ounce, as the vaults in London and Shanghai hit rock bottom. This is the final stage of the collapse. When the world realizes that in a crisis, a paper contract is just a digital promise that can be broken, while physical silver is the only reality. When the paper markets break, and the error 404 appears on the exchanges, will you be holding the receipt or the real asset? The clock is ticking faster than the charts show. Physical reality does not accept digital promises. You can print trillions in currency, you can manipulate paper contracts, and you can hide the truth behind a screen, but you cannot print physical silver to power a technological revolution. The 820 million ounce hole is a mathematical certainty, and it is the final countdown for a fragile financial system that has reached its absolute limit. The question is no longer if the silver market breaks, but what your life looks like when it does. Most people are terrified of being wrong, so they stay in the safety of the herd, but the herd is standing on a collapsing bridge of debt. The real risk isn't holding an asset that moves slowly. The real risk is being 100% dependent on a system that can devalue your entire life's work with a single policy change. Are you positioned for the fallout, or are you still waiting for the crowd to tell you it's okay? The clock is ticking,